There's a great opportunity the first of the year to convert to a Roth IRA because the government's looking for a way to get a whole bunch of tax money coming in. So they're giving a break where if you convert to a Roth, you'll take the tax hit, whatever it is, but you can pay it over 5 years. There's no income limits anymore. So you could do that and essentially build up a self-directed IRA in a Roth that when you take the money out at retirement or whenever, it's not taxable. That's huge. That is really, really huge, and the government's opening that window starting in January.
And a lot of the people that you talk to and work with are going to be people that have sizable retirement accounts, and they may want to buy a business, they want to buy a commercial property, they want to try to do a rehab or some kind of a project. And so now this could be the only way for them to really get going, or especially to raise the equity piece of a deal. So you may be putting a deal together where you're going to be able to maybe get a loan for your client, but there's a 30% piece that has to be equity, and this would be a way for them to do it. So it can make all these deals possible. And I think it's great, John, from the standpoint of people doing this because even though, like you said, people are starting to come back to where they were, and I'm not even sure that they are really, but over the past 10 years, equities have been flat, haven't gone anywhere. We can celebrate things are coming back to last year, but the reality is that people that have bought and hold have gotten nothing, mostly for the last 10 years. And interest rates that are being paid on bonds and fixed income investments are like nothing, and have a lot of risk because of the risk of default on non-sovereign debt and the risk of capital losses. And so this is a great way for someone to take control of their life and maybe transform their lives like the way that this person did that you indicated, because they could get involved in an investment or doing loans or something else and build a very successful business where it just wouldn't be possible otherwise had they not known about this. I think it's great.
Absolutely, Richard. What I'm finding right now is there's a lot of deals out there that are viable deals that nobody will fund, so they're looking towards friends and family. And friends and family will say, I'd love to get into that, but all my money is tied up in my retirement accounts. There's just huge opportunity. It's kind of a shift in the way that what the banking system's done basically to consumers and to the business community over the last 2 years. It's a shift almost to a grassroots type of alternative financing that, okay, you're not going to lend to us. There's trillions and trillions of dollars in IRAs. The IRS and the Department of Labor allow us to do it. It's just a matter of really educating the people out there. And one of the things I think is exciting is we're coming across these opportunities at the point of inflection. We're not really advertising, hey, we do self-directed IRAs. We're coming to deals that can't get done unless we do self-directed IRAs. So it's almost becoming a necessity in the capital markets to figure a way to get the deal done. And right now there's so many opportunities. In businesses in terms of valuations are very low. Real estate obviously is very low. This is the time to make all the money, and this is a way to do it. Basically what I put in this presentation was the top 3, and everyone says, well, I've never heard of this before. Is it legal? Can I do this? And obviously, yes. When they passed ERISA back in '74, making IRAs available, there's only a couple of investments that they don't allow. They don't really tell you what you can invest in, but they tell you what you can't. And you can't invest in life insurance contracts, collectibles, art jewelry, stuff like that. And there's a few other things. There's actually, in the state of California, they do allow you to invest in vintage cars. So you can actually invest in collectibles in terms of cars. But there's a lot of different things that you can invest in. I've got a slide later that shows just some of those things. And why haven't we heard about it? And basically, the regulators, when they first set it up, they basically thought, Wall Street would be best to inform clients on what to do. So from the beginning, as I said here, brokers and bankers created the misconception that buying stocks, bonds, and mutual funds is all that was allowed. And that's just not true. And obviously, I started out in the wirehouse and bank environment, and I would not have been allowed to do self-directed IRAs. And it wouldn't have been in my best interest to do it because then I'm having assets leave the bank or the investment banking firm I was working for. So an investment advisor or banker, last thing they want to do is see those assets leave their institution. So that's why those advisors are not giving their clients the advice. They're just saying either you can't do it or they don't know anything about it. And that's why it's not common knowledge. It's really coming out of their accounts. Basically, in terms of getting started, it's really a simple process that we go through. It allows us to just get a basic information, and then we put together a trustee-to-trustee transfer. And at that point, it goes to our accountants and tax attorneys and processors where they set up the corporate structure. They set up all the paperwork necessary, if there has to be mortgages in there, if there has to be member agreements, whatever has to be done. It's pretty simple. To get the process rolling, it's nothing more than a one-pager and a statement. And then if it's a complex transaction, it's prudent to have a conference call with one of our CPAs or tax attorneys to make sure that we're setting up the transaction correctly. In terms of opportunities of what you can do, I touched on real estate, mobile homes, like promissory notes. I mean, you could lend money to businesses if you wanted to do that. You could do hard money lending. You could trade commodities. I mean, you could put it in your self-directed IRA and then flip it over to a Schwab account or whatever and trade stocks if you wanted to do that. You could do factoring. We have clients that are doctors, and you may have 4 doctors in a clinic, and they have an LLC, and they can't lend to themselves, but they can factor the other doctor's accounts receivables. So the IRAs they set up are factoring for the other doctors, which allows them to do things like build out their clinics or get equipment and things like that. You can invest in limited partnerships. The IRA could own 100%, let's say, for example, of a mini storage. It could own half of it. It could own a percentage of it, or the IRA could be a 10% partner with 9 other partners. It doesn't really matter. You could also use your IRA to set up a lease company. So if you wanted to lease anything, I mean, you lease cars to businesses, you could lease them equipment. And right now, companies that are really hurting, or businesses like restaurants and things like that, are just dying for capital to upgrade equipment or do rehabs to their current businesses. So, and they're not funding for restaurants right now. So we've done a number of those. Tax lien certificates is another one. It's a no-brainer. You can make 12 to 18% on your money. This is that you just don't know when it's going to get returned. It will. And obviously, the longer it goes out, the more you'll make on it. So these are just some. I have more on the bottom, which means it's really your imagination. I mean, anything you can imagine that you can invest in, you can do, except for obviously artwork and collectibles. Basically, what I did here is I kind of put about 4 examples of actual clients that we've worked with over the last couple years. And the first one here is an individual that they had a jumbo mortgage, and obviously they hated paying interest to the bank. They also got the jumbo mortgage when they used to have what were called stated income loans, because the person was self-employed. Well, in this case, their arm was readjusting because it was a jumbo. They couldn't get financing because obviously they don't show enough income on paper to get financing. So they decided to just roll their IRA over and buy the mortgage on their home. And there's a couple advantages to that. One is the fact that they're paying interest to themselves. The other thing is they get the interest deduction. But the third thing, which is even better, is they get a asset protection feature, meaning that if somebody were to say, okay, I'm going to sue you, and I want to take your house, or I got a lien against your house, they can't touch that until the first mortgage is paid off, which is owned by the IRA, which is huge. So basically, by the IRA owning the mortgage, no matter what happens, if somebody sues you, you're still going to get all your money back, and it's all going to be sitting in the IRA. I usually use the example, one of the reasons O.J. Simpson moved to Florida is because that's one of the states that protects their IRA, and you're not allowed to sue or touch that money. On the bottom, we basically just put kind of what the referral fees would be on a case like that. And it's pretty lucrative, and you'll find that pretty much everybody you bump into has a mortgage. The only thing we have to look at, in some cases, the people that have mortgages are still working for companies, and they may not be allowed to do an in-service distribution, which means they may not be allowed to take money or roll over their current employer-sponsored plan without leaving service. So if that's the case, you may be out of luck, but there's a lot of plans that do allow it. We've got a list of about, I'd say, about 200 or 300 Fortune 500 companies that do allow in-service distributions. So we have that resource in-house. If you've got somebody, if we just look at the statement name